Hello, it is Friday, September 7th, 2007. This is Brian Shannon speaking. The market is just closed, and we get caught off guard by some employment report. And when I say we got caught off guard, not that obviously everyone knew that it was coming, but the reaction to it was pretty severe. And looking at the S&P 500, you can see we finished with a loss of $2.28. That was good for a loss of 1.5%. And the inverted head and shoulders pattern that we've been watching looks like it's now failed, as it's broken back below that neckline and it's back below that 10-day moving average. I thought yesterday might be acting as support, but as you'll see in a minute, the Qs are still holding above their neckline. So I'd been saying that this is really the important level for the S&P 500 on the daily time frame. Breaking below this area here, that's what I think is going to give us a really future problems, 143.80-ish area. So if it breaks below that level, then there's big problems actually. Looking at the weekly time frame, because last Friday, I had mentioned that, we need to keep an eye on this, and but basically that our shorter-term trade should be based on the shorter-term time frame. This is starting to look a lot more ominous to me, so you got to be really careful in here. The market came down in real heavy volume. It found a bounce on lighter volume here over the last 3 weeks, and it came up to that level where there was a prior significant level of support, which seems to be now acting as resistance. And if this is going to be a measured move type of play, we're just eyeballing it from about 145. Let's just be conservative here down to 145. And then we take the height of it from here at about 148. That would give us a price objective down near 138. So that's something to be aware of. We could be in for a lot more trouble in this market. It does seem to be holding between these two levels in here. But breaking down, I think, below that 143.80 could be the beginning of the next shoe potentially to drop here. Now, yesterday on the shorter term time frame, I was encouraged by these higher lows and higher highs in here, and it looked like this level of resistance was holding a support, and also the 5-day moving average was a reason to be encouraged, but that's all gone today. You can look at it and say that what looked like maybe the process of a bottom is now looking like a failed move here. So the this big gap lower today trapped a lot of people basically earlier in this week. Earlier in the week, the market was looking and acting bullish, and today we got heavy volume as people puke those positions out. Now we're going to need to see some stabilization and maybe this market can recover, but you've just got to continue to be very defensive in this environment. That's something I've been consistently stating since about right here, since late July, that you have to be very defensive in this environment, that the handwriting was on the wall back here from this failed move came a fast move. Now it looks like we've got another failed move that could potentially lead to another fast move. So really be on your toes going forward here. The semiconductors, they looked like they were going to hold that 50-day moving average. That 50-day moving average is now history as far as support. Interestingly in here we do have this head and shoulders pattern. It is holding above the neckline. So we've got a mixed message between the spiders, the semiconductors, and as we'll see again in a moment, the Qs are also holding above their neckline. But this is just completely failed in here. And yesterday I had said that below 48, I was thinking that maybe 48.10 was going to be a level of support. The market opened right at that level and just continued to get smashed from there. I said that if the market broke below 38.10, that then you would look for a move down to 37.50, 37.60, and that's why you've always got to be aware of the potential scenarios. Yesterday I was careful to say that I wasn't calling for that to happen because I thought the market looked kind of bullish in here, but you have to be aware of all potential situations so that you're not blindfolded when something like this happens. If you were involved in the semiconductors, hopefully you got out right at that open when it seemed obvious that there was a big problem here. And these big gaps, a lot of times, the bigger the gap, it typically leads to a trend day. So be aware of these big gaps, and I know a lot of people like to buy those gaps. And in the Qs yesterday, I said that maybe I would look to buy a gap low. Let's take a look at those in a minute. But the IWM continues to be the weakest. This is the, if we look at the weekly time frame, this is 1, 2, 3, about the fourth week in a row where we've tested that 80 level, the 80-20 level, and looked like maybe it had a chance of breaking through that prior through that resistance level, but no such luck, and this market is just continuing to look ugly. If we look at a conservative target here and go from 85 to 75, that would give us a target down near 70 as far as a measured move go. This from this high to this low right in here, and again measuring very conservatively, looking at the subsequent bounce, they tend to equal the height of the prior leg right in here, which was 10 points, and that would indicate down to $70 a share. This market is the weakest, and it continues to be really just something that you have to be very aware of. Looking at this monthly time frame, you can see that this trend line has been important. It's holding bullishly on this monthly time frame above the highs of early 2006, but breaking below here could really spell disaster. And this is, again, this is the important level right in here. This level is at about what is it, $76.30. I was just looking at my notes from yesterday, but what I had said in here was breaking below 78.20 would be a reason to be very defensive. My definition of being defensive means raise cash, look to go the opposite way, in case you're wondering what I mean when I say stuff like that. But this market is, you know, best case scenario, it's got some time to do some healing in here, but it's just really looking terrible in here. We've got a resistance at the 20-day moving, 200-day moving average, and we've got this declining 50-day moving average that continues to say the burden of proof remains on the buyers here. The Qs, these looked like they were holding up. Big volume came in today. Again, though, it is still above the neckline of this head and shoulders pattern. The most important level going forward is going to continue to be about 46.70 in here. But we've got that 50-day moving average. Possibly we're going to see some support unfold in here. This is the level where I said I still wouldn't be surprised to see it pull back down towards that 50-day moving average near the 48 level. Let's see how it acts in here. If the market can stabilize, there's a possibility it can turn around. But right now it looks and feels pretty ugly. At the same time, though, when it looks real bad and feels real bad, that's a lot of times when the market's turned. So that sounds very non-committal, and it is, because we just don't have the evidence to make any bets in either direction with any conviction right now. I think you've got to remain very nimble overall in this market.